Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
So, if you've ever been in corporate finance, heavy FP&A, treasury, investor relations, and suddenly you're modeling a huge, totally unexpected share buyback.
Oh, yeah. Or a massive debt reduction target.
Exactly. Or maybe a strategic spin-off plan that just seems to appear out of thin air.
Then you definitely know the real influence of hedge funds.
Yeah, forget those sort of dramatic movie images, secretive billionaires pulling strings.
Right. The reality is often, quieter, but maybe even more impactful, like a really detailed, maybe 20-page activist letter hitting the CEO's desk.
And that letter can change everything.
It really can. Their influence, it's less about, broad market chaos and much more focused. It's about specific critical decisions inside a public company, operational financial decisions.
We're talking valuations, strategy shifts.
M&A deals getting pushed through, These are major forces.
Okay, so if your job involves the company's balance sheet, protecting it, optimizing it, you really need to get past those stereotypes. Understand the actual mechanics here.
That's the goal.
Our mission today is basically to boil down the research. What do hedge funds really want? And maybe more importantly, how should your team respond? Tactically, maybe before things even escalate.
Proactively, ideally.
Okay, let's unpack this.
Right. Maybe start with the basics, the structure, because even the definition gets a bit fuzzy sometimes.
Good point.
So a hedge fund, fundamentally, it's a pooled investment vehicle, simple enough. But the key difference compared to, say, a mutual fund is this huge amount of regulatory flexibility.
Flexibility, right. They aren't stuck with rigid rules or having to just track a benchmark index.
Exactly.
Our sources really highlight that. They use this wide range of sophisticated strategies: distressed debt, arbitrage, global macro. But let's take long-short equity. What does that actually mean in practice, and why is that flexibility so crucial for them?
Long-short. It's absolutely key. It lets them chase absolute returns, whether the market's up or down. They can bet against companies they think are weak. That's the shorting part. While at the same time, buying companies they see as strong going long.
So they're playing both sides.
Pretty much. And that flexibility plus using derivatives, using leverage, it means they can take really concentrated positions. So they take on risks that, a standard mutual fund just couldn't.
Okay. And this is, I think, the absolute crucial point for anyone listening from corporate finance. Many of these funds, they don't just buy stock and wait. They invest actively. They take activist positions.
That's the pivot point.
They're fundamentally trying to push companies. Change strategy, improve the governance structure, maybe sell off assets they see as non-core.
And that activism, that's what transforms them. They go from just being another shareholder to being this really potent, sometimes disruptive force that finance teams absolutely have to be ready for.
Yeah. Okay, so let's talk about those perceptions then, because here's where it gets really interesting. We should probably bust some of those myths that still float around, right?
Definitely. Myth number one is probably that hedge funds are always destabilizing markets. Creates chaos.
You hear that a lot.
Yeah, but while they can certainly cause volatility, especially around a specific stock they're targeting, they often bring something else to the table. Liquidity, for instance.
Adding liquidity? How so?
Well, by actively trading and taking positions, they can provide buying or selling interest where it might be thin, and they often uncover genuine market inefficiencies. Things others have missed. They're essentially arbitraging information or execution speed, which, can actually improve price discovery in the long run.
Interesting. Okay, what about the second big myth? This one seems really popular with critics, that they only care about short-term profit, swoop in, shake things up, make a quick buck, and then leave a mess behind.
Right, the slash and burn idea.
Yeah.
The reality, though, it's usually a lot more nuanced. I mean, yes, every fund wants to maximize returns, obviously, but the really effective activist funds, they often push for quite deep foundational changes, operational improvements.
Like what, for example?
Things like serious cost rationalization programs or maybe strategic spin-offs of whole divisions. These things take years to really execute properly and see the full benefit. So the payoff isn't always immediate. The benefit can genuinely be long-term for all shareholders, not just the fund.
But hang on. If they force a spin-off today, isn't that often about getting an immediate valuation bump on their big position so they can exit quickly. Is the long-term gain just like a fortunate side effect of their short-term goal?
That's the inherent tension, isn't it? Yes, they absolutely want that value uplift, and their time frame might be shorter than management's ideal. But they are incredibly effective at accelerating value creation. Often that means forcing management to finally deal with inefficiencies or strategic questions they've maybe ignored for years.
So they light a fire under them.
You could say that. Whether their own holding period is 6 months or 6 years, the pressure they apply forces changes that generally benefit shareholders broadly, even if the activist fund itself doesn't stick around to see the final chapter.
Okay, makes sense. And the last myth,
Mm.
the size thing, it just feels kind of counterintuitive that a relatively small team could actually influence a huge Fortune 100 company.
But they absolutely do. It's about the concentration of their stakes and the sheer amount of capital they control. Our sources specifically call out names like Elliott Management, Pershing Square, Carl Icahn's Icahn Enterprises.
The big players.
Exactly. These funds manage billions. Their resources, their research teams, and crucially, their willingness to wage very public battles. It gives them influence far beyond what a typical pension fund or passive institutional investor could ever wield just by holding shares.
And they've proven it right.
Oh, absolutely. They have successfully targeted and forced changes at giants. Think Apple, AT&T, eBay, the list goes on.
Okay, so powerful check, activist check. If their main goal is influence, how do they actually deploy that power? How does it hit a company's strategy, its balance sheet directly?
Yeah.
Because, the corporate finance and treasury teams, they're the ones on the front lines, building the models, responding to this pressure.
Right. There are probably three main ways they exert direct influence. The first is by influencing the company's valuation, mostly through stock price movement.
How does that work?
Well, when a well-known activist fund discloses a large position, say 5% or more, the stock often jumps, almost immediately. It's not because the company's fundamentals changed overnight.
No, it's anticipation.
Exactly. It's the market pricing in the catalyst effect. Investors anticipate that management is now under immense pressure to perform better, unlock value, maybe make a strategic shift that the fund is pushing for.
Okay, so they buy shares, the market reacts. But how do they turn that initial market buzz into actual change inside the company?
Well, that leads right into the second area of interaction.
Yeah.
Actively shaping corporate strategy. They don't just sit back and wait for the quarterly earnings call,
They're much more direct.
Much more. They'll file these detailed public letters, sometimes scathing, outlining management's perceived failures. They'll nominate their own candidates for the board of directors. They might launch full-blown proxy battles to get shareholders to vote their way.
Wow. And their demands.
Very specific, and often aimed right at the finance function. They might demand, say, a huge spin-off of a particular division, or deep cost-cutting measures across the board. Or they might push for fundamental changes to capital allocation, different debt levels, bigger buybacks, different dividend policies.
Things that require immediate financial modeling and strategic rethinking.
Absolutely. And the third major lever they pull is driving M&A activity.
Pushing deals.
Yes. These funds frequently push companies towards mergers or acquisitions or even divestitures, deals that maybe management had considered but found too complex or perhaps too politically sensitive internally.
So the fund provides the external pressure to get it done.
Precisely. By applying that direct shareholder pressure, they can really accelerate deal-making. Deals that might otherwise have languished or taken years to come together, they create this real sense of urgency.
Okay, those are powerful mechanisms.
And when you look at specific examples, the real-world case studies, the scale of this influence just becomes incredibly clear. We should probably look at three quick examples. They highlight the different types of activism, capital returns, strategy shifts, even operational turnarounds.
Definitely. We almost had to start with the classic one, right? Carl Icahn and Apple back in 2013, 2014.
The textbook case. Icahn took a huge stake, billions of dollars, and then just relentlessly, publicly pushed Apple to dramatically increase its share buybacks.
Yeah, I remember that. It was all about Apple's massive cash pile.
Exactly. It was a direct assault on their capital allocation strategy.
Yeah.
He was forcing a public debate about that cash hoard. Now, Apple initially resisted, pushed back a bit.
As you'd expect.
Right. But the pressure, both public and likely private, just became immense. And eventually, Apple significantly expanded its share repurchase program. It became one of the largest in corporate history at the time.
So the finance takeaway there is pretty stark.
It is. Activist pressure directly accelerated the return of capital to shareholders. It forced an outcome that internal planning hadn't delivered on its own timetable.
Okay, case 2. Elliott Management versus AT&T in 2019. That was different, right? More complex.
Very different, much more operational and strategic. Elliott went incredibly deep into AT&T's financials and strategy. They sent this highly detailed 23-page letter publicly.
23 pages, wow.
Yeah, and it basically tore apart AT&T's recent big acquisitions, especially Time Warner, criticized their overall capital allocation, the debt levels, and they pushed hard for specific actions, divestitures of non-core assets, significant debt reduction.
And did AT&T respond?
They did. They announced plans to streamline operations, they committed to selling off certain non-core businesses, and they essentially agreed to refocus their capital allocation, including paying down debt.
So that case really shows how funds can shape not just buybacks, but core M&A strategy.
And critical decisions about leverage, the whole balance sheet structure, absolutely.
Oh, third example. This one shows the operational side, right? Bill Ackman's Pershing Square and Canadian Pacific Railway, around 2011, 2012.
Yes, this one's fascinating because it wasn't just about the money or the assets, it was about leadership.
What happened?
Pershing Square wasn't happy with the railway's performance, so they led a proxy battle.
To replace the CEO.
Exactly, to replace the CEO and install their preferred candidate.
That's plain hardball.
That's the ultimate escalation, really. A direct governance attack. And they won. The result? Pretty transformative. The new CEO and management team implemented major operational improvements, focused heavily on efficiency, network improvements. It led to significant margin expansion and, over the next few years, a dramatic increase in shareholder value.
So here, the hedge fund acted as a direct catalyst.
For deep corporate restructuring and a major operational turnaround, primarily by changing the leadership itself.
Right. 3 powerful examples. The lesson seems clear. They are catalysts, sometimes uncomfortable ones. So if you're that finance professional listening, how do you anticipate this? How do you respond strategically? We've seen the disruption they can cause, but how do you maybe channel that energy or at least prepare for it?
Yeah, preparation is everything. The first and probably most crucial step is simply be prepared with data. Corporate finance teams can't afford to wait until the activist shows up to start running the numbers.
You have to anticipate their moves.
Exactly. You need to be building models that anticipate specific activist scenarios before they happen. If a big buyback is a likely demand, you need the valuation models, the liquidity analysis, the debt capacity impact all ready to go.
And if they might push for a spin-off of a certain division?
Then those pro forma financials for the SpinCo and the RemainCo need to be modeled out internally. Sensitivity analysis done.
Basically, do their potential homework for them before they even assign it.
That's a good way to put it. The second key response flows from that. Continuously stress test your own capital allocation. You have to constantly ask yourselves internally, are our dividend policies optimal? Are our buyback levels right? Are our reinvestment plans truly creating the most long-term shareholder value?
Because if there are weaknesses in your own analysis,
an activist analyst who lives and breathes this stuff will absolutely find them and exploit them.
Makes sense. What else?
Third strategy, strengthen your communication. This is Investor Relations 101, but it's critical here. Transparent reporting, clear articulation of your strategy, proactive engagement with shareholders.
It reduces the ammunition for an activist.
Precisely. If you communicate your strategy effectively and, crucially, the rationale behind your capital decisions clearly and consistently, it leaves much less room for an activist to come in and successfully claim that management is confused or mismanaging assets.
Build your narrative first.
Exactly. And finally, maybe counterintuitively, don't always treat them purely as the enemy you have to fend off.
What do you mean?
Well, the sources suggest that many sophisticated companies are now finding value in engaging early. Proactively reaching out to significant shareholders, including known activists, inviting dialogue before things escalate.
Try to find common ground.
Sometimes, or at least understanding their perspective directly. It can often lead to a smoother, less costly, and maybe even a more mutually beneficial outcome than a public fight.
Avoid the proxy battle if possible.
If possible, yes. Dialogue is usually less expensive and less distracting than all-out war. So if we sort of pull all this together, synthesize what we've discussed, the core strategic takeaway really is this. Hedge funds, especially activist ones, aren't just speculators. They are powerful stakeholders. Their concentrated presence often signals that change is coming, one way or another.
Whether you like it or not.
Right. And whether you view that potential change as a positive catalyst or a negative disruption, proactivity is really your only effective shield. Model those scenarios rigorously. Communicate your own strategy clearly and confidently, and make absolutely sure that every major capital allocation decision you make can truly stand up to intense, informed scrutiny.
So what does this all mean? Well, here's a final thought to chew on. If hedge fund involvement so often acts as the catalyst for these critical changes that often do create shareholder value, like bigger buybacks, needed debt reduction, or even replacing underperforming leaders, doesn't their success maybe reveal something deeper, like perhaps structural weaknesses in corporate governance? Weaknesses that maybe companies should have already addressed internally without needing that external push? It really forces you to think about where true accountability lies inside a corporation and whether management teams are genuinely always optimizing shareholder value before that external pressure cooker gets turned on. Something to definitely mull over next time you're reviewing your company's own strategic planning timeline.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.